Hi, I'm back again. This is Chapter 3, Part 2. And in this part, we're going to talk about some of the basics of accounting. So we talked last time about the principles that accounting rules are based on, accounting principles are based on. And now we're going to talk about some of the conventions of accounting, which date back to actually Venice in the 15th century, when double entry accounting was basically created. So we're going to talk about how accounting works, how the numbers get where they're going, and the basic setup of financial statements. So we'll talk about those things in this area, and then we'll continue on and get involved a little bit in understanding how transactions get recorded. You've done some transactional recording in the case study you did. Presumably, unless you've had accounting background before, you probably ad-libbed a little bit. And we'll see how an accountant would do that, and we'll talk about that also in a separate video. So, first of all accounting fits into an equation. So those of you who are mathematicians or engineers understand equations, understand basic math, and accounting is really, really basic math. If you can add and subtract, multiply and divide, you can do accounting. There's very little higher mathematics, and in fact, if you got through 6th grade math, you should be able to do virtually anything that's required in accounting. So the primary accounting equation is the balance sheet equation, and that is that a firm's assets always equal its liabilities and its equity. So the left-hand side of the equation, assets, is the firm's resources, things that we own that have value. The right side of the equation is the claims on those resources. And the claims on those resources are liabilities, which is things I owe that I'm required to pay at some point in time, sooner or later, to credit holders, outsiders who have granted me credit. They've lent me money, they've sold me goods and said I can pay them later. They've allowed me to do things that I have to pay for later. All of those things are liabilities. And then equity is also a claim, but it's the stockholder's claim, the owner's claim on assets. So assets equals liabilities plus equity. If you wanted to, you could switch that equation around by using algebra and say assets minus liabilities equals equity. So everything I own, assets, minus everything I owe, liabilities, the net of those two items, assets minus liabilities, equals the owner's share of the assets. What's left after I've paid my liabilities is what belongs to the owners, the equity holders. So that's the equation, pretty simple equation. Because it's an equation, whenever I affect one side of the equation, I have to affect the other side in the same manner. So if I increase assets, by definition, I have to increase either liabilities or equity. So if the left-hand side of the equation goes up, the right-hand side of the equation goes up. If I decrease assets, I have to decrease either liabilities or equity. So that's how we get to double entry accounting, which we'll talk about in a few minutes. So assets, resources owned by the firm, and an asset is anything of economic value that can help the firm provide its goods and services to its customer, either directly or indirectly. Those are academic definitions, but they're good definitions. So asset, something I own that has value. Easy thing to understand. In an individual sense, if you own a car, that's an asset. If you own the clothes on your back, that's an asset. If you own a house, that's an asset. If you own some pots and pans in your kitchen, that's an asset. Those are things that you own that have value. You might own your car No, let's stay right there. Just stick with that definition. We'll talk about what I was going to say in a few minutes. Two kinds of assets. There are tangible assets. That's things I can touch, things that have a physical form, and they're shown on the financial statements. Intangible assets don't have form. Things I can't touch, things like patents and trademarks, and something we'll talk about later, goodwill, are intangible assets. And GAAP accounting treats intangible assets two ways. If I buy an intangible asset, if I go out, you develop a patent and I go out and buy it from you, then it shows up on my balance sheet as an asset because I paid for it. If I hire some scientists to go in a lab and work for a couple of years and they develop a patent, which I own because they're my employees, I don't show it on the balance sheet. Their labor I have expensed. I have not put it on my balance sheet as something I own. So therefore, intangible assets can be treated differently depending on how they're acquired. If they're developed internally, they don't show on the balance sheet. If they're purchased from outside, they do show on the balance sheet. So that's a little bit of a twist. That comes from an accounting principle that's very embedded in generally accepted accounting principles in the US, which is called historical cost. What did I pay for it? The reason that this dichotomy exists between intangible assets is, well, I could hire a couple of scientists to go work in a lab for a couple of years to develop something, and maybe they'll develop something that's patentable that has value, or maybe they won't. Maybe they'll work for 2 years and come up with nothing. At that point, if I haven't expensed their salaries, I've overstated my income, and I have nothing to show for this thing that's sitting on my asset called on my balance sheet called research. So generally, U.S. accounting is very conservative and says, no, we can't capitalize those things. So for companies like drug companies and software companies, that's a fairly significant issue. I'm going to spend years developing a piece of software, but I can't put that cost of developing the software on my balance sheet. I have to expense it as it goes along, even though the income from that isn't going to happen until a lot later. So different. International rules actually allow you to capitalize internally created intangible assets in some cases. So international rules are a little different there. Goodwill is an intangible asset that comes from the purchase of another business. So if I buy a business and I pay more than the net asset value for the business, that extra money that I pay is considered to be goodwill. So the market value of tangible assets we can figure out. So let's take a simple example. If I am running a landscaping firm and I have 100 customers, each of whom spend about $2,000 a year with me. So I have $200,000 of revenue, my landscaping firm. And you decide to buy my landscaping firm. You own one in a different town and you want to expand into my town. So you're going to buy my business. Well, you're going to buy my lawnmowers. You're going to buy my trailer that I move the lawnmowers around with and my pickup truck that I tow the trailer with. And maybe I have a garage where I store things. So you're going to buy those assets. Those are tangible assets that you and I together can arrive at a fair value for. But you're going to pay more than the value of those assets because you're getting something else. You're getting my going concern, which has very satisfied customers and generates $200,000 a year in revenue. You could go buy the lawnmowers from, Home Depot or something, or you could buy used ones from Craigslist. But you're buying my lawnmowers, but you're also buying something else. You're buying this firm that has $200,000 of business and 100 satisfied customers. So you're going to pay me more. So let's say my assets add up to $50,000 and you pay me $80,000 for my business. The difference, that $30,000 that you pay, is called goodwill, and therefore you're going to put that goodwill on your balance sheet when you buy it. The only time goodwill shows up on a balance sheet is when it's a purchased goodwill. Now, my company had that goodwill and it wasn't on my balance sheet before I sold it because it was internally developed. But once I sold it, there's a market value on it. This arm's length transaction, and we're going to consider that as an asset. So goodwill is a different kind of an asset. It shows up on many companies. Any company that's done an acquisition generally will have goodwill because they usually pay above tangible asset price for the company. So that's the asset side of the balance sheet in a short and sweet. The liability side of the balance sheet is things that we owe to outsiders, and those would be things like accounts payable. And the meaning of accounts payable is the way accounts payable, where they come from, is if I buy something for use in my business and I don't have to pay for it yet. So I go out and buy supplies, I buy raw materials, I buy, if I'm a retailer or wholesaler, I buy finished goods. And the person I buy them for says, well, I'm going to ship them to you, but you don't have to pay for 30, 60 days, 90 days. Those are all accounts payable. I have the asset, I've acquired the asset, let's say raw materials, and I haven't paid the company that sold me the asset yet, so I owe it to them. So I'm going to record an increase in assets and an increase in liabilities until such time as I pay for the goods. So that's accounts payable. Notes payable are generally borrowings from banks or individuals, and that refers to the fact that when you lend money or borrow money, there's a note that you sign agreeing to pay it back. So that's a notes payable. They can be either short or long term. Bonds payable are another kind of borrowing, usually from outside parties, not institutions, and they're generally securitized. So bonds are securities that can be traded. So they're another form of borrowing. And then we accrue liabilities when we do something that we haven't paid for yet. So when you work, very few of you, I assume, work and get paid before you work. Generally speaking, the way payroll works is you work and then you get paid later. So I'm going to work for 2 weeks and then I'll get paid. If I'm being paid bi-monthly, I'll get paid a week after I finish my 2 weeks of work. So I'm always paid late, which means the company has gotten something of value, my labor that they have to record, but they haven't paid it yet, so they also have to record a liability, payroll, accrued payroll. So almost every company has accrued payroll. Many companies have accrued utility expenses because we generally use utilities before we pay for them, and so forth. So those are accruals. So I've used something and I haven't paid for it yet. And then owner's equity is the owner's share. So we talked about assets equals liabilities plus equity, or assets minus liabilities equal equity. Owner's equity is the owner's share. In a partnership, it's called partner's equity. We're going to be dealing primarily with corporations where it's shareholders, stockholders' equity. In a nonprofit, there aren't any owners, so it's called net assets. So it's assets minus liabilities. If a nonprofit has more assets than liability, they have net assets. If you notice under corporation, there's a whole bunch of other words that mean the same thing. So net worth is the same thing as stockholders, shareholders' equity. Book value, another way of looking at shareholders, stockholders' equity. Net assets, the same thing that we talked about in nonprofits. Equity and capital. All of those things mean basically the same thing, shareholders or stockholders' equity. And they get used interchangeably, so they're good words to know, because people will say, oh, what's the net worth? Oh, we have this much capital. Well, that kind of stuff, that they're all referring to shareholders' equity. And then book value per share, we take the book value or the shareholders' equity, same thing, and divide it by the number of shares outstanding. So if I have a $100,000 book value or shareholders' equity and I have 1,000 shares, the book value per share is $100. So that's the book value. That doesn't necessarily mean that that's what the stock will trade for if it's a publicly traded stock, because we talked about it doesn't include the goodwill that's there. But it does give you an asset value for each share of stock. Now, the other accounting equation that we're going to talk about is the income statement. So the income statement also has a fairly simple equation. Revenue, income, sales, whatever word you want to use for revenue, minus expenses equals net income. So if my revenue is greater than my expenses, I have a profit or net income. If my revenue is less than expenses, I have a loss. So pretty simple equation again. If I bring in more than I send out, then I have a profit. If I don't, then I have a loss. So revenue is the amount earned by selling goods or services to customers. Pretty simple. I think that's a simple definition and a pretty accurate one. Expenses are the cost of producing the goods and services that I sell. Once again, pretty good definition. Now, costs are, we're going to get into costs later when we get into managerial accounting, but costs are sometimes hard to determine, but the costs of providing goods or services that I sell. We record these things using something called debits and credits. Before we get into the debits and credits for accountants don't really mean anything. They come from Latin words that mean left and right. So they aren't your experience as individuals. You've got debit cards and credit cards. Those words don't mean anything. They actually refer to how the bank records transactions when you use your debit card or credit card. So these things don't mean anything. And they've come to have meaning outside of accounting, but within accounting, they're just a logic system. So a debit is to the left on an accounting journal, and a credit is to the right on an accounting journal. So the next slide, we'll get into more depth on this. The next slide shows you what debits and credits look like. A debit is a plus to an asset, and a credit is a minus to an asset. But on the other side of the equation, they do the exact opposite. On the other side of the equation, a debit is a minus and a credit is a plus. So therefore, if I debit assets and credit liabilities, my equation stays in balance. So if and an example of this is if I pay an accounts payable. So I owe money to a supplier and I pay them. So currently I have cash and I have an accounts payable, money due to a supplier. So if I credit cash, take money out of cash, let's say I owe the supplier $100, so I'm going to credit cash $100, and that reduces my cash, and then I'm going to debit accounts payable, which takes the accounts payable away because I don't owe it anymore. I reduce liabilities. So I'm going to reduce cash and reduce liabilities by paying my debt, by paying what I owe, paying my liability. That's a simple explanation. We're going to get into more depth in this in the next chapter, but this is sort of a beginning thing. So if you can get these arrows down, so debit is a plus to something on the left-hand side of the accounting equation and a minus on the right-hand side, and vice versa for credits. That's a good start. It does get a little more complicated, and this is where people start going off the rails. So there you go. There's a bigger, more difficult chart. And if you notice, here's stockholders' equity includes common stock. So this is when a company sells stock to an individual, that's common stock. Or um, retained earnings, that's the money that the company has made that they've kept, that they haven't paid back to shareholders. So here you've got the signs are the same. So debit is a minus and a credit is a plus on all of these. But retained earnings really comes from the income statement. So if I've earned money, then I'm going to increase retained earnings. If I've lost money, I'm going to decrease retained earnings. So every time we sell something, a credit is a plus and a debit is a minus. Every time I pay salaries or rent or whatever, I'm reducing retained earnings, which is in turn reducing stockholders' equity. So debit, credit. And when I pay dividends, it has a similar effect to retained earnings as expenses do. So those are all the signs. That gets more complicated. I would recommend that as we start this course, that you focus on this first yellow line. See if you can internalize that before you try to figure out the rest of this. It's all pretty simple. It's all logical, but people get confused. So that's your debits and credits. And early on in the course, we talked a little bit about some jargon, and we talked about accrual accounting. All GAAP accounting is accrual accounting. So we only record things for financial statements using accrual accounting. And what accrual accounting is we recognize revenue when we earn it, and we recognize expenses in the same period that we recognize the revenue. So that the expenses that are used to earn that money are recognized in the same period, and that's the matching principle. So we've got accrual accounting. Every financial statement is accrual accounting according to GAAP, so that's the accounting rules. We can't use any other kind of accounting. It's just accrual accounting, and it's pretty simple. Recognize revenue when we earn it. Well, we earn it when we do our part. So if we're shipping goods to a customer, as soon as we've shipped the goods, we've done our part. That's when we're going to recognize the sale. And it doesn't matter when we get paid. We're going to recognize the sale when we do our job, when we do what we're contracted to do. And then we're going to recognize expenses that match those revenues. So if we had to pay warehouse personnel to pack up the box and ship it, that's an expense related to that revenue. We're going to record that revenue at the same time we record that expense at the same time we record the revenue, even if we haven't paid the warehouse employee who did the packing. So we're going to record the expense for packing the box at the same time we record the revenue for packing the box, for shipping the box. So that's the accrual accounting principles. Cash accounting is very different. Cash accounting, that's probably the way you handle your own personal finances. Most people treat their personal finances on a cash basis. We recognize revenue when we receive the money. So we recognize revenue when we get paid, not when we earned it. We earned it over 2 weeks, but we get paid next week. We're going to recognize the revenue when we actually get our paycheck. And we recognize expenses when we actually spend the money. So we don't consider the utility expense we're incurring right now on recording this lecture. We consider it when we get the electric bill at the end of the month. That's cash accounting. Not allowed for GAAP, not allowed pretty much anywhere except, and this is important, the IRS recognizes cash accounting. Cash accounting, you end up with very different answers than accrual accounting. It doesn't take into effect economic effect. It takes into effect when cash changed hands. So the IRS will let businesses report on a cash basis as opposed to an accrual accounting basis. And some businesses do that, primarily professional firms. So doctors, lawyers, accountants often report their tax earnings on a cash basis. And the reason they do that is that they can defer taxes by doing so, because all professions tend to be paid very slowly. So we do the work, and it takes a long time for our customers to pay us. If I'm a lawyer, I may do a lot of legal work and then get paid, a year later. So if I use cash accounting, I don't have to report that income until I actually get paid. So the IRS allows that, and obviously once the IRS allows something, people take advantage if it's to their benefit. So cash accounting is used for tax purposes sometimes, but generally not for financial reporting purposes. And the reason is it doesn't really tell us much about the business. It tells you cash in, cash out, but it doesn't tell you how the business is doing on an economic basis. So that's the end of Chapter 3, Part 2. Please answer the couple of questions after this, and then continue with the lesson plan for this week. Thanks.